Between January and April of 2025, gold ran from roughly $2,600 to nearly $3,500 an ounce. That is almost $900 of movement in about 90 days. Retail traders watched that rally happen on the same charts as every institutional desk on the planet, and most of them did the same thing. They chased it, they bought the breakout candles, they market ordered into momentum, and then they watched price retrace right back into the zones they just bought through and stop them out. The institutions, meanwhile, were not surprised by those retracements. They expected them because they understood something most retail traders still overlook. When price moves that fast, it leaves behind empty space on the chart, and the market almost always comes back to fill it. That empty space has a name. It is called a fair value gap. In this video, I'm going to break down exactly what a fair value gap is, why it forms, why it matters more on gold than almost any other instrument, and how you can use it to stop chasing and start waiting. We will look at the mechanism behind the fill, walk through a real chart scenario, and talk about the specific mistakes that keep retail traders on the wrong side of these setups. Not financial advice, just education. Let's get into it. So what is a fair value gap really? A fair value gap, or FVG, is a 3-candle pattern where the middle candle moves so aggressively that the wicks of the first and third candles never overlap. That gap between the first candle's high and the third candle's low, or vice versa on a bearish move, is the FVG. Think of it like a hallway that everyone sprinted through so fast that nobody actually stopped to open any of the doors. The rooms are still there, the orders behind those doors are still there, but no transaction happened at those prices. The market moved through that range without a proper two-sided auction, which means it left unfinished business behind. Now here is the part that matters. When you have a zone on the chart where buyers and sellers never properly met, there are unfilled orders sitting in that space. Market makers, the firms whose entire job is to facilitate large institutional orders, need that liquidity. They need price to return to those levels so they can match their remaining size. The market is not random at this level of structure. It is a liquidity-seeking machine. It goes where the orders are, not where retail traders hope it will go. So why does this matter more on gold specifically? Because gold is one of the most liquid and most volatile instruments in the world. It routinely prints 15 to 30 pip ranges inside a single candle on a 5-minute chart. When you get a session opening move during London or New York, gold can displace 80 or 100 pips in 15 minutes. That kind of speed creates fair value gaps constantly. And because of gold's deep institutional participation, those gaps fill with a consistency that you rarely see in forex pairs or even indices. Let me walk you through what this looks like in practice. Say it is a Tuesday morning, London session has just opened, and you are watching gold on the 15-minute chart. Price has been consolidating overnight in a tight range near a key daily level. At 7 a.m. London time, a large candle fires to the upside, followed by another strong displacement candle, and then a third candle that continues higher but with a smaller body. You look at candle 1 and candle 3, and their wicks do not overlap. There is a visible gap between the high of candle 1 and the low of candle 3. That gap is your FVG. Now here is where retail and smart money diverge completely. Retail traders see that momentum and they buy it. They see 3 green candles in a row and they think the move is confirmed, so they enter at the top of the displacement, usually with a stop that is way too tight because they are trying to protect a late entry. The smart money approach is the opposite. They see the displacement as a delivery of price, not an invitation to chase. They mark the FVG, they wait for price to retrace back into that gap, and they look for a reaction inside it before they enter in the direction of the original move. One group is paying full price for a trade that has already happened. The other is waiting for the discount. The midpoint of the FVG, sometimes called the consequent encroachment level, is often the cleanest entry. It sits right at the 50% mark arc of the gap, which avoids both the shallow rejection where price barely taps the top of the FVG and moves without you, and the deep invalidation where price slices through the entire gap and your setup is dead. If you're going to trade an FVG on gold, that midpoint is your line in the sand. But here is the question you should be asking. Do all fair value gaps fill? And the answer is no. The title of this video says the gap always fills, and in my experience on gold, the vast majority of them do eventually get at least a partial retracement, but eventually can mean the next session, or it can mean 3 days later when the context has completely changed. The important distinction is between a high probability FVG and a low probability one. And that distinction comes down to one thing: alignment with higher time frame bias. A beautiful bullish FVG on the 15-minute chart means almost nothing if it sits inside a bearish leg on the 4-hour chart. You are looking at a continuation trap, not a trade setup. Retail traders mark every gap they see because it feels productive. Smart money only cares about the gaps that align with the higher time frame direction, because those are the ones where institutions actually need the price to return for order filling. The gap is not magic by itself. It is a footprint, and you need to know whose footprint it is and where they were walking before you follow it. So how do you filter for quality? You start with the higher time frame. Is the daily or 4-hour chart showing a clear directional bias? If it is bullish, you only care about bullish FVGs on the lower time frames, the ones formed by upward displacements. You ignore the bearish gaps unless you have evidence of a structural shift. Second, you look for a liquidity sweep before the gap. An FVG that forms after price has taken out a previous swing low or a cluster of equal lows carries more weight, because the sweep tells you that institutions grab their liquidity before moving price. An FVG without a sweep beforehand has roughly half the reliability, because you do not know if the move was driven by real institutional intent or just a thin market overreacting to a newsprint. Third, and this is where most people get sloppy, you respect time. FVGs that are more than 3 to 5 candles old on their formation time frame start losing their relevance. If you marked a gap 4 hours ago on a 15-minute chart and price has not come back to it, the market may be extending rather than retracing. Do not sit there refreshing the chart waiting for a fill that might not come. The best FVG trades on gold happen quickly. The displacement fires, price moves away, and within 1 to 3 candles, it pulls back into the gap, shows you a reaction, and then continues. If that sequence does not happen, the setup is stale and you move on. Here is the honest part, and I think this matters more than any of the technical stuff we just covered. Fair value gaps are not a guarantee. They are a probabilistic framework, and probabilities only work if you manage risk on every single trade. You need a stop loss. On gold, that stop goes below the swing low that preceded the FVG, not just below the bottom of the gap itself, because gold regularly wicks 15 to 30 pips inside a gap before reacting. If your stop is sitting right at the gap edge, you will get hunted on a regular basis. Do not overmark your chart. I see traders who have 16 FVGs drawn on a single 15-minute chart, and they wonder why nothing seems to work. If everything is a level, nothing is a level. Pick the 1 or 2 highest quality gaps in the current sequence and trade those. Ignore the rest. And on bad days, which happen to everyone, do nothing. If London opens and gold is chopping in a 20 pip range with no clean displacement, there is no FVG to trade. Do not force one into existence because you want to feel like you traded today. The best trades I never took are the ones I walked away from on days where the structure was not there. Here is what I want to leave you with. A fair value gap is not a line on your chart. It is not a zone you color in and hope price hits. It is a record of a decision. Somewhere an institution or a market maker moved price aggressively because they needed to fill size, and the gap they left behind is the evidence of that decision. When you trade the fill, you are not predicting the future. You are reading what already happened and positioning yourself for the most likely next step. That shift in thinking from predicting to reading is the difference between guessing and trading with intent. Now I want to hear from you. Drop a comment below and tell me this. What time frame do you use to identify your FVGs on gold, and do you filter them against the higher time frame bias, or do you trade every gap you see? I am genuinely curious because I think the answer will tell you a lot about where you are in your development. If this kind of breakdown helps you see the chart differently, hit subscribe. That's how the channel grows, and it's all I ask. I'll see you in the next one. Stay disciplined.